gentlemen, our distinguished delegates, good morning and welcome to session 6 of this conference. The session is titled How to Build a Successful Investment Portfolio, particularly for Household Savings. The objective of this panel discussion is to help hundreds, maybe thousands of people who want to be more serious about savings and investment, but they don't know how and where to start from. So this is going to be the focus of this 1 hour or maybe 1 hour, 10 minutes panel discussion. Originally, this session was supposed to be moderated by Rasha Sibai, an investment and research professional, but she couldn't do it this morning due to work emergency. Hence, I'm stepping in and hope to meet her expectations. I'm not an investment person, and I'm facing this morning with the 3 investment gurus. I hope we try to make this good for everyone. So let's start. Before we start the questions and discussion, I would like maybe to give each one of you around 1 minute to introduce themselves and their corporations. So let me start with Raphael, if possible.
Yes, sure. Thanks a lot, Ibrahim. So my name is Raphael Sobotka. I'm a division head of multi-asset within Amundi. As you know, Amundi is a leading asset management company, particularly in Europe and in Asia, also very present in the MENA region. I'm in charge of a few strategies there. I'm in charge of flexible strategies, so total return strategies, for example, some quantitative strategies like risk premium strategy. But more importantly for you, I've got also in charge retirement solution strategies with a very significant business, particularly in Europe.
Excellent. Altaf?
Yep. Assalamu alaikum, everyone. My name is Altaf Qasim. I run a team called Investment Strategy and Research for EMEA in State Street Global Advisors, which is one of the world's largest asset managers. We cover clients across the spectrum, from sovereign wealth funds to clients who deal with retail investors, even though we don't ourselves directly deal with retail investors. And just like Raphael, one of the major parts of our business is retirement. So we look a lot at retirement, both defined benefit and defined contribution plans, helping our end clients, save better and retire with dignity. That's one of our phrases. Thank you.
Excellent. Steve.
Morning, Ibrahim. So I used to be a management consultant in the region in the Middle East for over 12 years, advising sovereign wealth funds, especially, and some other financial institutions on how to improve their strategy, investment performance, and things like that. But eventually I realized that it was people that needed the help, and that's where my calling was. And I helped enough institutions that I was able to choose what I wanted to do with my life, and I choose to help individuals learn how to plan, save, and invest by themselves. So I'm the founder of Deadsimplesaving.com, and it does what it says on the tin. I really believe that saving and investing can be dead simple if you learn the basic processes that a lot of people, a lot of companies don't necessarily tell you about. So I'm very delighted to be here today.
On that note, Steve, I'd like to start with you on the very name of your company, Deadsimplesaving. There are lots of people, is there now, economically speaking, and maybe from the investment perspective as well, can we say that there is an optimal saving and there is suboptimal saving? So there is generic saving and there is a professional way of saving. Because maybe if we have 2 brothers, 2 sisters, 2 colleagues, and both of them are saving $2,000 every month, but maybe one is putting it in a bank account, bank cash account. The other is putting it, and I don't know, maybe in one of the strategies done by Raphael or Altaf. We need to frame this issue from the grassroots. What's a proper saving, and is there an optimal saving and a suboptimal saving? Let's start with you, Steve, and then go to Raphael and Altaf. Go ahead.
Sure. I really think it's important to have a sense of direction, and that's why I'm a big fan of financial independence, because what it does is it gives you a framework in which to fit all of the different pieces of your financial life, whether that's your mortgage, your credit card, your cash, your investing, your crypto, whatever it might be. It all fits together to allow you to reach your goals, whether they are to give you the option to stop working at your corporate job if you want to, maybe 10 years earlier than you ever thought possible. And with that sense of direction comes a great reduction in stress around money, because you know where you're heading. So yes, cash is important and saving is very important. And I think as an individual, you need to know where professionals can help you and where sometimes they don't help you. A lot of that is driven by commission. I think that's commission tends to be where professionals are receiving money to advise you or to put you into certain products. I think that's where things tend to go a bit wrong. And so I think it's important as an individual to know enough of what you can do, and then where you need to step in and get a professional to help.
Yes, Altaf, is there something that we might label as optimal versus suboptimal way of savings or investing?
I think it depends on each individual's objectives and constraints. So that's always how we start when we discuss with any client, any project. What are they trying to achieve? So what are their objectives? And what do they not or cannot do in terms of their savings? So, for example, Sharia compliance is a form of constraint. There are certain sectors or companies that you can't invest in. And those are the foundations, I guess, for building an investment or a savings plan for anyone, from an individual all the way up to the largest sovereign wealth fund in the world. So for us, the optimal plan depends on the combination of objectives, constraints, and then obviously other factors.
I might direct this question better. We're talking here about household long-term savings. So maybe this defines the question better.
I think it's still the same approach, that you still need to think about what you're trying to achieve, if it's saving for retirement, but also you may have interim goals. For example, your children's college education, you may want to buy a house in the future, you may want to move country. So everyone has different objectives, and everyone does have different constraints. They might be dictated by their income, by the country they live in, the tax status they have, for example. And so when you talk about optimal, it is definitely different for everyone, but there are some behaviors or traits that I think everyone should keep up. And you talked about them a bit in the last session. You know, you should start saving early, you should save regularly, you shouldn't be trying to time the market. And I know we'll get onto these at a later point.
Thank you. Raphael?
First, yes, I fully agree with Altaf. I think at the end of the day, it's optimal. It exists optimality, but optimality for each individual because of different objectives, different goals, different constraints, different also risk capacity. I agree with this. I would like to add maybe something. What is the human capital side? Because very often when we think about our savings, our long-term savings, we just think about the money side, okay? Which means basically we think about the amount of money we have today, okay? So existing wealth, maybe the income, so basically the salaries that we get or rents that we get on the next few years, because typically we don't have long-term visibility. We have 2, 3, 5 years of visibility. And obviously the objectives, that is basically buy a house, retirement objectives, and so on. But very, very often individuals forget about their human capital. What does it mean? Is that if you are a graduate of MIT, you have a lot of human capital, okay? And even if, for example, you start your career very poor, or in fact, in negative wealth, because in fact, you own the bank, in fact, the MIT costs, in fact, your risk capacity is very high at the start. Why? It's very easy to understand. You lose money, but you are an MIT graduate. Very easily, in your career, you will make basically this money back. So you have a lot of risk capacity. Conversely, when you are older, even if you are relatively wealthy, I mean, most of your career is behind you. So your human capital as a proportion of your wealth may have decreased. And therefore, you may feel that you can take a lot of risk, but maybe it's not the case. By the way, when you grow also older, there is a limit to what is optimal in terms of risk taking. Why? It's very easy to understand. If you have already sufficient wealth to cover all your needs to the death, in fact, you don't have to take a lot risk. What you need to think is about transmission to your children, transmission to your family. But just for your own needs, there is a limit to the risk taking that you need, that is optimal in this sense. So again, there is optimality, but it's not only on money terms, it's also thinking about human capital and overall basically transmission mechanisms.
Ibrahim,
So
if I can just build on Raphael's point, he makes a very interesting point there. I have a lot of clients who are over 50 and thinking about retirement. And one of the biggest mistakes they've made, especially if they've been damaged and their portfolio has been damaged by unscrupulous commission-driven financial advisors, is that they feel like they need to take a lot of investment risk to catch up. And this is a classic mistake, because of course they could do very well and catch up, but they could do even worse, and then they're even further behind. And what they need to do, to go back to your original point about optimal savings and optimal investing, is they need to put as much as they possibly can into the market. So boost their income, reduce their savings, reduce their expenses, maximize their savings rate. But then when they actually put it in the market, they need to put it in sensibly and take an appropriate amount of risk for their age. And I think a lot of people make that mistake.
Thank you so much, Steve and Raphael. I think the two angles, they're very intriguing, both this sense of a critical need to catch up, and then you invest in risky asset in the hope you will secure better retirement, but also the notion of human capital uh, optimality and being an immense source of wealth. These are fantastic dynamic angles that we have added to this debate today. So going back, I'll go back to Altaf. If we continue to talk about household long-term savings, households' financial resilience, what sort of feature, what sort of characteristics, what sort of behavior we need to see in household savings discipline, the mindset, the discipline, the way to save, the way to invest? What are the golden rules that there are thousands of people, they try to make a difference in the way they manage their financial life, but they don't know what's the checklist, what are the golden rules. If we highlight these at the intellectual level before we go under the bonnet.
Sure. Well, thank you very much. So I think building on what Steve and Raphael have said, I mean, one of the goals, or and you used the word discipline, which I think is exactly the right word. It is about being disciplined, about being rigorous, about sticking to some rules. And I think the first rule is to start early. So you're never too young to start saving. And, you know, I have kids and they're already, I'm trying to get that idea into them that they should be saving. And we, as Raphael said as well, you know, we're thinking as a couple about how we're going to transfer our wealth to our children. So it's all, you know, it's really important to start early. The second point is to save regularly, to just keep saving, to always be, if you like, dripping money into the market effectively, because I think this quote is attributed to Albert Einstein. I'm not sure if it really was him, but that compounding is one of the most powerful forces in the universe. If you keep saving a little and your portfolio goes up a little, then, you know, over time with exponential growth, you should get a really good return on your savings, but you have to be in there for the long time. And the third point I made, which I guess, you know, is hard for people to stick to, is to try not to time the market, and especially don't be worried if the market takes a dip. Don't take your money out. That's often the worst time to sell. Just stay invested, and you know, the longer you stay invested, particularly in equities, the more chance you have of increasing your real savings power, your real retirement income, because that's what you need when you eventually do retire. You need to be able to maintain some standard of living above the rate of inflation, which is obviously a key topic right now. So start early, save regularly, and stick to that discipline. Don't try and time the market. Don't come in and out because you think that market conditions are either more favorable or less favorable.
Thanks, Altaf. If we turn now to Raphael on the same question.
I can add to that maybe the diversification angle, or maybe we can talk later about it, but I think it's a very important concept on top of what Altaf mentioned. Diversification is very often misunderstood by individuals, and to be honest, by also institutional investors. Diversification, for me, has to be thought about two key dimensions. One is asset diversification, and the other one is time diversification. Okay, I'm going to explain a little bit these two concepts. Asset diversification, if you think about it, why if you take two kind of assets, let's say, I don't know, US equities and German real estate, okay, why two assets correlate? So basically they go down at the same time or they go up at the same time. It's very easy to understand. You have three components. First one is that because they share the same fundamentals. It means basically the same macroeconomic basically cycle, which means basically when there is a strong growth in the US, basically US economy is doing well, you have two assets doing well at the same time. It's very easy to understand. So the same macroeconomic cycle, the business make money at the same time. That's it. The second element is valuation. The way everybody put a price on this asset has the same sort of driver. Typically, interest rates, for example, are the same way. You have interest rates that are used there. You have the same currency, for example, that are using the same valuation, and so on. So, for example, if you take two equity markets, let's say US large cap, US small caps, they belong to the same market, same fundamentals, so same macroeconomic driver, to make it simple, same valuation driver, interest rate. Obviously, the diversification is low. If you take, for example, US equities and German real estate, you don't have the same macroeconomic cycle. You don't have really the same valuation anchor as well. One is more US rate, the other one is more what's going on in Germany, in Eurozone. So obviously, you have a lot more diversification. And the last point that is also important to understand is you need to avoid having the assets that correlate, because overall, people buy and sell it at the same time. Example, people typically, they buy tech stocks everywhere on the planet at the same time, even if they are listed in the US or even if they are listed, let's say, in Europe or in Japan. So you have correlation. People at the same time, they like tech stock. On some occasion, they are going to dislike tech stock at the same time. Again, don't expect a lot of diversification. You have correlation among the behavior of participants. They buy and sell at the same time. So if you think about it, asset diversification is about these three things: correlation about their fundamentals, so their, let's say, macroeconomic cycle, their valuation, and basically flows, the fact that people buy and sell at the same time. The second topic is time diversification, because obviously the cycles tend to move, valuation tend to move, and also people appetite, buying and selling, tend also to change through time. If you diversify through time, you have a lot more diversification. And it's the reason why it's dangerous for household just to put a lot of money at one point in time. Is because they lack a lot of timing diversification. Is why it's very important also to save or invest regularly, because you achieve a lot of time diversification, and it is very powerful effect. I can give you an example. If today, for example, everybody buy and sell US equities and European equity at the same time, because European equity is seen as being very, very, very correlated to US equity, I can tell you that 20 years or 30 years ago, it was not the case. And maybe in 20, 30 years ago, it's going to be different. So you see, the correlation drivers are going to change through time as well.
Excellent. Steve. Steve.
I just classic mistake. So where you need to find a balance is between statistics and psychology, and that will make you a successful saver, and it will make you a successful investor. And you have to find and then follow and stick to a process that balances those two. So with the statistics, we know that you need to boost your income, reduce your expenses, maximize your savings rate, put it into investment, particularly long-term, high growth investments, like the stock market, etc., etc. And to do that, as Raphael and Altaf were saying, you need to firstly be in the market for a long time. And most of us hopefully will live to our 90s, 103, whatever it may be, and not take big chunks out. And therefore, we have a very, very long multi-decade time horizon, even if in that time we move country, we retire, etc., etc. Secondly, diversify, as Raphael just explained, diversify globally. Thirdly, keep fees low, because if there's one thing that's going to destroy your path to a great retirement, it's going to be fees. Don't worry so much about avoiding avocados on your toast and pumpkin spice lattes. It's more important to reduce the fees, much, much more important by an order of magnitude to reduce the fees on your investment portfolio. But that is all the statistical side of things. And as Altaf hinted, the psychology is actually what's going to trip you up every single day. And so I think it's really important to understand your why. You have to start with why. Why do you want all this money? What are you going to do with your life? If you can achieve motivation rather than discipline, then your saving is going to be that much easier. You are going to be excited to put money in your investment portfolio rather than buy that handbag or fancy phone. Then with your investing, if you are clear what your risk appetite needs to be to enable you to have the sort of size of portfolio that will generate income for you of a certain size that will give you a decent retirement, then you may need to adapt yourself to become better understanding of the stock market or the real estate market or whatever it might be, and to be able to ride out the ups and downs and the volatility as my colleagues were mentioning just now. So that understanding of the statistics and the psychology and the basic process, I think, is very, very important. And actually, once you understand that, I mean, it's not that complicated. And then the hardest part is just sticking to it.
Absolutely. I'd like to jump again on something you said, Steve, which is psychology. Psychology is associated with knowledge and confidence. And if we are to complete the intellectual foundation of this session, I would like to ask one more abstract question before we get into the investment side, which is, risk aversion. It's very much tied to psychology. So around the globe, predominantly households, individuals, families, they predominantly save in banks. And this is more so in developing nations and countries around the world. Maybe it's safe to say 90% of household savings, they sit in dormant bank account or fixed deposits. And maybe for economists like you, they are missing a lot of the upward. Um, how can we educate? What do we tell people here about risk management? Because the reason, maybe the very reason that 90% of household money sits today in the bank is maybe there is an associated risk. But for you, maybe, maybe for this money to sit in the banks for many, many years, maybe this is even a much bigger risk than the perceived risk of the households themselves. How do we educate people? How do we inform them so that they gradually take risk with a bit more confidence and they start changing their knowledge, behavior with money and so on? Let's start with Altaf again.
Yeah, I think, I mean, what we need to do, and this is a concept that's come more and more into the mainstream, is this idea of nudges. So some of your viewers may have heard or read or the work of Robert Shiller. He won a Nobel Prize a few years ago in economics for his work on behavioral economics. And you know, one of his ideas was this idea of nudges, that you have to keep, and as the word suggests, keep nudging people, keep reminding them about good behavior, about how they should be practicing, as you called it, Ibrahim, the discipline of investing. So, you know, there are a lot of good apps out there. I know you have a platform for these apps where, you know, for example, they round up your spending and they take that rounded up amount and they put it into a savings account and so on. And that enforces the discipline or nudges you into doing regular saving, which is one of the things I talked about. And then, you know, for example, when the market goes down, you know, your financial advisor or your investment manager should be talking to you and helping you understand that, you know, this is probably a temporary setback and that you should stay invested and so on. So I think this idea of being present, of nudging people, of trying to reinforce that good behavior constantly, not just, you know, when you start the savings plan and when you retire, but keeping those ideas going forward. But like you say, it comes from confidence, it comes from knowledge, and those are other things that we need to build up. With knowledge, inshallah, will come confidence, and people need to become better educated about the investment world, how it works, and important points that people don't want to talk about, like Steve mentioned, that you know, advisors take commissions. Sometimes they may be pushing you into higher cost funds because they get paid more for that. You know, people need to be aware of those things because at the end of the day, those make a huge difference. But I would say this idea of nudging, of constantly reminding people about good investment behavior, that is where good psychology and discipline comes from.
Raphael, 90% of people in the MENA region, they save money via banks because they don't want to make a loss. What's your comment?
I think that you don't have only the MENA region in this camp. To be honest, in Europe, if you take, for example, France and Germany, historically are also very, very conservative. Even Germany maybe a bit more than France. So also we have this exactly the same challenge to educate a very conservative client base. I would say that in this. We have progressed a lot on the past 10 years, thanks to financial planning tools. I mean by that, digital tools, okay, and robo advisor in the large sense of the word. Why? It's very simple. If you think about it, only a part of the population has got access to financial advisor first. They got access. To get access to a financial advisor, you need some amount of money, obviously, but also you need to like to see a financial advisor. And we have also clients basically trying to avoid financial advisor because they may think at the end of the day that they will feel that they are not enough educated to face financial advisors, that they are going, in fact, to take too much risk, lose money, give a lot of fees to the financial advisor because they know very well that it is costly, things like that. Over the past 10 years, thanks to having digital tools, we have made a lot of progress, particularly on this population who were avoiding, for good or bad reasons, financial advisor, because now they have access to digital tools when they can objectively look at their savings, basically, their saving discipline, so how much money that they're going to put into the equation through time, look at the probability of losses across time horizon. So what is the probability I'm going to lose my capital in 5 years, 10 years, and so on. And then they start to see that, in fact, with a sufficient time horizon, with sufficient diversification across asset and timing, well, in fact, the probability, in fact, to achieve a better outcome than just cash is very high with time, relatively high time horizon. It is, in fact, very, very, very high. Because obviously the client, they are myopic in terms of time horizon. They try to avoid a short-term loss. So because in fact, losing money in a few months or within 1 year to lose 20%, first, it's not very, let's say, a comfortable position. It's a bit humiliating. You don't know what to do. But they cannot understand that over time, they are going to be better off. Also, there is something very, very easy to understand. When you invest in risky assets, okay, equity, real estate, in fact, you buy a piece of the global economy. I mean, if you take a long-term horizon, the economy is growing. So the probability to be better off is high. On the short term, you can have a recession and so on and lose money. That's clear. Particularly if you are not diversified enough. But over the long term, the economy grows. And the economy grows because you have billions of people working hard to make the economy grow. And you are basically just putting a bit of money in this. That's it. It's about investing. It's just this.
Thank you, Raphael. That was fantastic. Steve?
Yes, I love what Raphael just said there. If you don't make your money work hard, you will work hard for your money. And literally, when you're in the MENA region, while you are asleep, your money is invested in American companies. We know Americans work incredibly hard. They get 2 weeks vacation a year. They are working. Your money's working very hard while you sleep. So I think the problem is in the region with this conservatism is there are very few role models of people who are investing. Your parents, your grandparents probably kept all their money in the bank. They probably have lots of real estate, land, gold, things like this. And so there aren't any role models. Secondly, people who have invested, there are lots of horror stories. People investing in individual stocks and it goes terribly wrong. People investing in scams and it goes wrong. People investing in long-term savings plans and getting ripped off. There are just like endless horror stories. And therefore, we need to kind of reassure people that actually, if you invest in the stock market in a sensible way, you're not going to lose all your money, as my colleagues just pointed out. I think you do need to redefine what loss means, because is it loss over an hour or a day or 6 decades? Is it a loss of 1% versus losing everything, which is what people truly fear? And so, of course, if you're investing in an individual stock or investing over a day, the risk of loss is huge. But there's the other risk of loss, as I think you, Ibrahim, pointed out at the start, is that if you keep your money in the bank, firstly, that bank, as unfortunately, our friends in Lebanon have seen, banks can blow up spectacularly. There's definitely risk there. But also, if you keep it in the bank, not doing very much at all, over 10 years of inflation, you probably lost about 20%. These days, probably like 30+%. And so if you can help people see that context and show that this is where the statistics help, make them very relatable and show to people, look, if you look at the US stock market, in fact, even most of the world, 92 years worth of daily data, there has never been a 10-year period, a 20-year period where you have lost any money. I'm not talking about everything. I'm talking about you haven't even lost a single penny, right? And if you're in a more conservative portfolio, like the retirement portfolio, so say 60% stocks, 40% bonds, there's never been a 10-year period where you've lost a single penny. So that starts to reassure people, and they say, okay, it's not just about betting everything on Tesla or whatever. It's about buying the world and managing the risk in that way. Then people slowly start to become a bit more confident. And then if they can surround themselves with other people who are with them and can give them sensible support, not even advice necessarily, but just support when the market crashes, so the world's not going to end. You know, is every single, if there's a nuclear war, and I sincerely hope there isn't, there'll be companies that do radiation cleanup that will do spectacularly well. We saw this during COVID, right? Zoom, Peloton, Amazon, Facebook. These companies did Pfizer. These companies did spectacularly well in a very, very difficult time. There will always be that diversification, and it's only when the aliens land that we truly have to worry about our stock portfolios.
Excellent, Steve. Going back to confidence, I mean, going always back to your confidence and psychology. How do we enhance the clients or people's confidence and psychology by informing them on what wealth management specialists, what asset managers, what investment advisors do as a homework in the back end that the clients themselves do not see? There is a lot of research and screening parameters or criteria or a checklist before Amundi or SSGA or others or Steve would advise or prescribe to clients. If we are to use this session partially as a probably master class, so that we tell people that the investment advisors, the asset managers, the wealth management advisors do a lot of homework meticulously to screen and select this investment for you, what are the high-level things that we would like to tell clients that we do this A, B, C, D things before we advise or prescribe any investment advice or vehicles to you? Let's start with Altaf.
Yeah, I think the first point to make is, I think we could be and should be more open about our investment process. And maybe in the past, it has been too much of a black box. And it's kind of been, look, just give us your money, trust us, and we'll do the right thing. And I think especially with the onset of ESG, which has obviously been a huge trend globally, clients are asking much more, investors are asking much more, why is this stock in my portfolio, or why is this stock not in my portfolio? You know, why did you exclude a certain stock or sector? And having those conversations, I think, is a lot more important. Before the conference, Steve and I were speaking, and this idea of voting and engagement, I think we need to be a lot more open about that. You know, when we hold large chunks of shares of companies, like Steve was saying, when we own slices of the whole of the world's economy, how are we being good stewards of that? You know, what are we doing to make sure that those companies are doing the right thing to avoid, you know, catastrophes like climate change or nuclear war, you know, to avoid those kind of things. So I think, frankly, Ibrahim, this is homework for the investment management industry. I think we do need to go away and be a lot more open, be a lot more transparent, be a lot more clear about how we are using our clients' money and why certain stocks are in and out. And I think ESG has been a great catalyst for that. So now we do talk to clients a lot more about exclusions. What are controversial weapons? Do you want tobacco in your portfolio? How do we deal with, issues like sanctions against Russia? What does that mean? And I think that has been a process which has been going on for years. But I think first the pandemic, and now the war in Russia and in the Ukraine, and certainly the onset of ESG has accelerated that process. But I think there's still work to be done in being more open and more transparent. And that's a journey that I think we're all taking in the asset management industry.
Raphael, there is a big homework for the investment industry. As Altaf said, there is inflation, there is sanctions, there is ESG, there are exclusions, but there are also the regular tedious fundamentals, quantitative and other, I would say, Catholic aspect, or orthodoxy, the old and good established habits of screening funds or maybe investment options.
It's a difficult one, because it is true that when experts like us deal with individual clients, you have a big information asymmetry. But I would say it's more an expertise asymmetry than an information asymmetry, because when you work with a company like us, I mean, we are very transparent, and we can give a lot of details about why we have this or this stock, this exposure, and so on. The issue that we have is that, particularly with individual clients, they don't understand what we are talking about. So if I take one of my portfolio, I give you all the details on exposure across equity market, factor exposure, so value stock, growth stocks, interest rate sensitivity, currency risk, hedging positions, ESG also integration as well across different sectors. I mean, I can send you basically a data pack of 50 pages, but no individuals is going to understand that. So I would say that first, interacting with a financial expert like us, it's about trust and fiduciary duty. You need to make sure that the professional you have in front of you is going to put a lot of effort in doing a good job for you. I think that is for me the ultimate point, that you have fiduciary duty in the company. Okay, and he's going to put effort on doing a good job and basically preserving your capital and increasing your capital through time according to your objective. And he's not going to let you down if you are in financial stress because you think that you have lost too much money and that you want to sell everything and so on. He is going to inform you through time. It's a bit like when you choose a car. I'm not a motor expert, therefore I have no idea whether this motor is better than this motor and so on, whether a BMW is better than a Mercedes and so on. Impossible. But you buy brands that you trust and offer you very good also after sale services. Okay. If there is an issue with the car, they are going to do good repairs. Okay. I think that is very important. I think progressively what we need to do is educate also the individuals and to put effort there. In fact, it's not very complicated to start with. If you take an investment product, only a few metric is going to give you what is behind the bonnet. You have basically equity market beta, so basically sensitivity to the stock market, interest rate, what you call duration. So in fact, it's a beta to interest rates. Okay. Maybe you have also credit risk, but it's very close to, in fact, equity risk, to make it simple. Then you have FX, so forex risk, whether it's in US dollar, in your own currency, is pretty important, and also liquidity risk. So in a way, in 4 or 5 different metrics, you understand 80–90% of what is under the bonnet on investment product. I think progressively individuals need to understand these metrics. Okay, because if you don't understand these metrics, in fact, the asymmetric information or expertise between you as an individual and the expert is very, very huge. Okay, and obviously everybody is looking at past performance, and past performance are going to be related to the different metrics. And therefore, if you don't understand what kind of risk the asset manager have taken and what have been the result, in fact, past performance are very misleading. And I think this is a big issue. But it comes as a journey where, in fact, individuals and experts like us do a better job together.
Excellent, Raphael. That's very insightful. Steve?
Yes, I mean, to continue the car analogy, I think as long as you choose a reputable company, then the main thing is that you get in the car, there is gas in the tank, and that you put your seatbelt on. And there are so many people who get analysis paralysis and don't even get that far. I do like to keep things very simple, and time again, I just have a few companies that are fund managers and provide globally diversified ETFs, exchange traded funds, which are kind of somewhat easier to access for people in this region, I find. And therefore it comes down to fees. Are these products cheap? Can you be accessing them cheaply? Obviously, you don't want to compromise on quality, but most of these large companies these days are producing amazingly diversified, accurate ETFs that are very cheap. Scale, are these companies big? Where people tend to go wrong is that they invest in piddly little things, either funny little ETFs that are very niche, or with small companies that actually don't have a reputation. Are these companies secure? Are they going to get hacked? Are they going to make some ridiculous computer mistake and then you could lose your money? Are they effective if they say they're tracking this benchmark and it goes up 10%? Is the fund and your money going to go up 10%, or is it going to go up 9.6%? It's probably more important when the market crashes. Is if it goes down 30%, is your fund going to go down 37%, or you can't get your money out, or whatever it might be? That tracking error becomes very important. And then I think impact, and this is where I struggle the most. I think what Altaf said was very important, is that ESG, it's fine to have an ESG fund, but if we see you as a company voting on our behalf, and your reputation is to vote against every ESG motion at the AGM, then eventually we're going to stop investing in your company. So I really believe that you should vote with your money and your time and your energy in causes that you believe in. And I think more and more people, and the generations below me, the millennials and the Gen Z people, this is all they believe, right? And they will do it. And so I think we all have to change, and we have to be transparent about this. So you can't offer ESG and at the same time say, oh well, I'm voting at the AGM on behalf of shareholders everywhere, i.e., I won't criticize these oil companies about their carbon. The world has changed completely now, and so I think that's almost an existential risk that you have to consider when you're screening these companies. Companies have to be seen to be behaving sensibly and in a fiduciary manner, but with also a positive impact in the world.
I think it's been great to have you, Steve, because we have a couple of top 10 asset managers in the world, but you also do the commentary that overshadows what they do, and also the stock that they include in their portfolios and the meticulous process they follow. There have been a nice flow of questions by the audience, and we will come to them maybe in a couple of minutes. There is one question that I'd like to combine with one of my questions. The question says, what could be an ideal asset mix or asset allocation typically these days in this current time or current period for a household saver, say an affluent guy or family? But I would like to add to that, how could that differ if we are talking an employee saving scheme for a big corporates in the MENA region? And I'd like to start with Altaf again.
Yeah, thank you very much, Ibrahim. So I think the concept which was introduced earlier about how earlier in your career, you should be able to take more risk because, as Raphael pointed out, you have a higher human capital. And then as you get towards retirement, you should be taking less and less investment risk, at least, and thinking more about transferring wealth. That definitely holds. So, we use the concept of a glide path, which I think is quite common in the investment industry. And for example, for defined contribution retirement, which is where investors or individuals put money into investments and they hope that those grow over time until they can use that growth at retirement. What we think about is, okay, for example, inshallah, I'll retire in 15 years' time. So I'm at a place now where I'm probably starting to take less risk, whereas inshallah, my son will enter the workforce in 5 years' time, and he'll start with a much more risky portfolio. But if he can put his investments into what we call a target date fund, over time, that fund will do the asset allocation for him over time, and it will move from a risky to a less risky portfolio without him having to consciously think, okay, now I'm turning 30, now I'm turning 40, I need to add more bonds and take out some stocks. So I think this idea of glide paths and target date funds is another way that we can enforce good and sensible investment behavior by guiding investors towards a particular landing point, which is what we call it. And then, of course, what you do with the money is up to you. When we talked before about objectives and goals and constraints and so on, you need some money that you need to live on. And as we've also mentioned, you need to make sure that that is above the rate of inflation so that you still have real spending power. And then you have other money for what you might call goals. You might want to buy, another home overseas, or you might need to fund your children's education, or you might want to give a gift to your grandchildren and so on. So, I think when you approach retirement, you need to start thinking about living and goals as well and split them up. So that's how I would say, you should thinking about asset allocation. Once again, the optimal asset allocation is different for everyone, but the idea of starting early, saving regularly, and then some of the other points that Raphael and Steve brought up about diversification and low fees, they apply throughout the whole process.
Thank you, Altaf. That was fantastic. Raphael, I think that the one who posed the question maybe wanted or loved to hear that maybe I would put 15% in this asset class or 25% in this. I will avoid this. I will do that. Maybe the expectation was that you will also speak about certain allocations in the asset. Maybe.
But it depends on the type of risk and so on. So really the capacity of the individuals to take risk. I mean, there is no magic formula for everybody. Because again, I fully concur with Altaf. What we propose and what that has been very successful. Not for us, I would say, for our client, because it's more important that our clients are successful than we are successful. But what has been very successful for our clients or our individual investor has been, in fact, the mix of using digital tools to understand very well what kind of risk they can take and what kind of optimal mix of asset is optimal for them, and glide path. In fact, glide path, when in fact is a sort of automatic pilot of your investment. Okay, and what is very important to understand is that at the start, individual investor, they say, okay, I'm going to put only a little bit of my money in automatic pilot, but I want to retain a lot of degree of freedom because I want to do this and that and so on. And through time, they put additional money in the automatic pilot. Why? It's very, very, very interesting because at the start, let's say that you have, okay, let's say that you are wealthy, you have $1 million of savings. You have a lot of projects full in your head. Okay, you say, okay, I want to do that to buy a house for my kid and so on. But in fact, in reality, most of your money stay in the bank account. So at the start, you are going maybe to put only 10%, so let's say $100,000 in the automatic pilot. But through time, you say, well, in fact, this project has not worked. This project, I don't want to do it. And you put additional capital in the automatic pilot. So the confidence in investing grows through time. We is that our client have been very successful to get out of being very, very conservative in bank account to take a bit more risk thanks to this mix, digital tools and glide path.
Thank you so much. I'll go back to questions from the audience and maybe run them by the three of you. I will start with Steve. And this questions comes from, I think, a life and pension advisor. They say, is capital guarantee an option as a solution for corporate pension schemes? I would like to hear your comments because typically some of the conservative or risk averse clients, they first ask about, is our capital guaranteed? So this is what the question is. This starts with Steve and then Altaf and Raphael.
I think it's a very interesting question, and it's actually a technical question. I think it comes down to what you are promising as an employer to your employees, because obviously the trend has moved from final salary or gratuities, where final salary pensions or end of service benefit gratuities, which were essentially fixed, right? Like you earned it and then you were owed that money. In which case a capital guarantee is very important if the company was to invest that money and then had to give out a certain amount based on someone's salary and tenure, versus a defined contribution pension where the investment risk has completely moved onto the individual. And if that risk has moved to the individual, then I would say probably and fully moved to the individual, I would probably avoid capital guarantees because they're expensive, and I would spend the money instead on educating your employees about risk and asset allocation and things like that. If there's any hint, though, that, for example, there is a minimum level that you will pay out as an employer, then absolutely, yes, you would need a capital guarantee. But I also defer to the experts on this. So I'd be interested to hear what they say.
Yes, Altaf.
Yeah, I mean, Steve makes absolutely the right point that a guarantee is effectively a form of insurance, and like any other form of insurance, you have to pay a premium for it. So when you have a guarantee in place, someone is paying for it, whether it's coming out of your pension, you're getting reduced rates, or your employer is paying for it through the actual corporation, and in some way, that guarantee has to be paid for. And it will probably end up reducing your investment return. Now, that might be a price you're willing to pay because you want that guarantee. But I think, as Steve says, on the whole, it's probably something where if you follow the disciplines we've been talking about, if you think about the time and asset diversification that Raphael has been talked about, is not necessary. But again, every scheme is different. Every employee is different. There may be certain cases where that guarantee is helpful, but you have to realize, just like any other form of insurance, someone is paying for it, and it might be you.
Thank you. That's insightful. Raphael,
yes.
I think you are already managing some retirement portfolios, so maybe this is a typical.
Some with protection, and some without protection. I believe that, first of all, I fully concur. At the end of the day, there is a cost. There is a cost for any capital guaranteed or protected vehicle, whether you see it or not, but you need to know that there is a cost. Typically, it's a bit of lower returns. So it has to make sense for the individual. Typically, we propose guaranteed product or protected product for individual investors who are quite conservative and have got relatively short-term time horizon. And we believe it makes sense because if you are conservative and have relatively short-term time horizon, let's say 2 or 3 years, in fact, a big equity market correction can be very tough to you. Very tough to your wealth. You don't have the time basically to recoup your losses, and therefore having a bit a lower return, so a bit of additional cost makes sense when you are in this category. But obviously, if you have a very long-term horizon and you are not so much risk averse, it doesn't make sense to have capital guaranteed strategies. You need to also to understand that the cost of the guarantee typically depends on also on interest rate in some shape or form. And the good news is that now interest rates are coming up. They are going up again. So the cost of guaranteed product were relatively high on the past few years because of ultra low interest rates a bit everywhere. Let's take the US. US dollar interest rates were very low, and they are increasing. 25 basis points every Fed meeting this year, we'll see. But therefore, this guaranteed product will be more attractive in US dollar in the coming quarters.
Thank you. To further extend this very notion, in the world of investment, we talk about maybe diversification and concentration, and which is equal to risk and reward. I mean, that's another analogy as well, or a acronym, or a formula in the world of investment. I'd like to ask a question around this. Sometimes we have a household who is simply saving $500 per month towards financial security, towards emergency buffer, towards retirement. And sometimes, as the audience just asked 5 minutes ago, he was speaking about a corporate pension of a company. When it really makes economic and investment sense to ensure that the savings go to well-diversified strategies, and we have fund of funds, and we have allocations to different strategies. And when we should find that too complex, and this is merely $1,000 a month, and if it's just put in a single fund, the mutual fund is enough. I mean, when do we lose? I mean, there is diversification, but maybe there is over diversification and loss of any economic meaning. So in the space of household saving versus corporate pension saving, how complex, how advanced, how rich we need to be on the investment mix itself? We've been in this in this long-term savings and pension for some times, and we have seen that people go all the way from creating 20 fund of funds to making sure that they have 200 individual funds on the platform for people to choose. I mean, where does it really make sense? Where is the balance here? I would like to start with Altaf.
Yeah, I think, yeah, shukran. I think Steve made a really good point, which was that especially with the onset of ETFs, you can be really, really well diversified across asset classes and across regions, and you can do it with just a couple of instruments. So, at the very basic level, you could buy what we call an all countries world ETF, so that invests in the stock market across developed and emerging markets, and that might be absolutely sufficient for you when you're just starting your savings journey, when you're young, when you should be fully invested in the stock market. And then as you grow closer to retirement, you can start to blend that in increasing amount with what we would call a global aggregate ETF, which is invested literally in all the bonds, in a large proportion, shall we say, of the bond markets of the world. And with just two instruments, you can actually create a very well diversified, globally diversified portfolio, which should also, because ETFs, generally have low fees, should have low fees, shouldn't involve a lot of investment expertise, a lot of what we call governance. You don't have to be in and out of the market every day watching the stock market. You can see the prices of these ETFs. So you can make it a lot more complex. Things that we do tell clients to avoid, though, investors to avoid, which are typical other behavioral issues, is what we call home bias. Don't be over-invested in your country that you live and work in, because very likely you're already exposed to that economy through your employment, through your house, and you don't want to be extra exposed. People feel like they must be experts in the field that they work in, which they probably are, So they invest more. So if I'm in a tech company, I start to invest in more tech stocks. Again, that's kind of the opposite of what you should do. You're already exposed to the sector through your employment. Try and diversify outside of that. So avoiding home bias, avoiding other sorts of biases are important, but you can keep it very simple, and literally 2 instruments can guide you through a lot of your investment journey.
Thank you, Brother Altaf. Raphael?
I'm going to add a few insights on this because it's an interesting subject. First of all, when you invest, you need to think about whether the risks that you take are going to be rewarded or not. Okay. Typically, all the key risks that I mentioned, particularly equity risk that is related to global economy, is rewarded. Interest risk is relatively also rewarded. Okay, credit risk more or less the same. Okay, these are the 3 sources of only liquidity risk as well. Okay, there are the 4 sources of risk that are rewarded. Okay. To make it simple for individuals, it's very difficult for individuals to know whether what we call the Sharpe ratio, which is basically the reward per unit of risk, is going to be different in one of these 4. It's very difficult. Even the expert like us, we are spending a lot of resources, hours, to understand whether one may be better than the other. I think for individuals, it's a daunting task. So they need basically to put diversification according to this equity risk, duration risk, so interest rate risk, credit risk, liquidity risk. Okay. Typically, these 4 risks, they have the same amount of reward per unit of risk. On these 4, you have no limit to diversification, except that you need to maintain your cost down. So this is the difficulty, that you have the impression that you are diversified, but in fact, you are always buying the same 4. You are always buying equity risk, duration risk, illiquidity risk, credit risk, but it's the same. It's the same. And if you are adding layer on apparent diversification with basically going up in terms of costs, you are losing. You think that you are benefiting, but you are losing. But if you are piling up in different geographies, different sectors, and so on, different interest rate risk, a bit of US dollar risk, a bit of euro risk, and so on, in fact, you are improving your portfolio. And the big if is if you keep your cost at the same level. And then there is also what is mentioned by Altaf that is pretty important, is also complexity, because the issue is that individuals tend to behave, let's say, relatively badly with complexity, particularly when they start to lose money on a portfolio that is complex. They tend to take bad decisions. Therefore, you lose even more money when you have a complex portfolio. So you are basically removing at the wrong time the portfolio. But and going back to concentration is that it's very tempting because you have the impression that you are going to be quite rich, to make a lot of money with being concentrated. But it's a bit like gambling, unfortunately, being concentrated, except if you think really objectively that you have an edge. Because when you make a lot of money, somebody else is losing. So if you are basically managing a concentrated portfolio, it means that you are going to make a lot of money against other market participants that are going to lose a lot of money. Therefore, you need to believe that you have a market edge. Warren Buffett is running a concentrated portfolio, leveraged and concentrated portfolio, because he believes that he has a strong edge to basically to find a few companies that are undervalued, and he's going to make a lot of money. But it's not something that individuals can do at all, because they cannot basically have this edge that, let's say, Warren Buffett has got.
Thank you so much. I think that's really very elaborate. Steve, if you would like to add anything to what Raphael and Altaf said, but also because you are not an asset manager, and you can be objective on this. I would also like you to elaborate a little bit on the risk of fees. The Raphael and Altaf have many times referred to the cost of accessing multi-complex investment options and the fees associated with them being one of the risk. That it's like inflation, if you like.
Yes, absolutely. Really, simplicity trumps absolutely everything. And as Altaf said, it's never been easier to have a very simple, globally diversified ETF portfolio these days. And as Raphael said, that the more complex you get and the more you layer things on, then the higher the fees get, but the lower the diversification benefits get. And what that leads to is underperformance and confusion and fear for the client. And so the reason fees are important is if you look at the long-term stock market performance over many, many decades, you're averaging about 7% globally. And so if a fee is 1%, that sounds pretty low. I don't mind the odd 1%. My financial advisor's very nice. Here you go. There's 1%, no problem. And the funds that the advisor puts me in, they're between 1% and 2%. Okay, no problem. But each 1% is coming out of your 7% profit that you make each year. And so that's about 13% of your profits. And unfortunately, what we're seeing in the Middle East, a lot of these complex plans, when you add on the platform fees and the transfer fees and the mirror fund fees and the fund management charges and the advisory fees on top, you're looking at maybe even 4%, a lot of these fees being somewhat hidden. It's a little bit like an iceberg. 4% out of 7% is 58%. And if someone, as salesman, came up to you and said, oh, here's a wonderful product, it's just going to cost you 58% of your profits each year, there's no way that you would invest in it. So I think to come back to Altaf's original point, which is that these days, with the technology that is available, it's never been easier to have a super low cost, highly effective portfolio. That's what you need to do. And the challenge for the asset manager is to make it look like they're actually doing something. Because to be honest, and when I say the asset manager, I mean the whole industry. So the financial advisors, the fund management companies, the insurance companies, etc. Because it's increasingly possible for an individual to just set up an international brokerage account and buy a stock fund and a bond fund by themselves. And so you have to be showing that you are adding value. And if you look at cars, cars have 4 wheels and a steering wheel, and then there's a whole lot of marketing essentially. And the danger is that there's a lot of marketing and complexity that doesn't really need to exist and is adding fees or adding to corporate profits, but isn't generating profit for the individual. And so I think, look, when you're dealing with institutions as an asset manager or in financial services, go and do whatever you want. It's business at the end of the day. But when you're dealing with individuals, I really do think you have to take a very long, hard look at yourself and saying, like, are we actually adding value as a to the individual investing? And I think the balance between that and providing value for your shareholders of your company, a financial services company, is going to be increasingly difficult, and that's going to be a real challenge, hopefully an exciting challenge for you.
Thank you, Steve. That was a very fantastic perspective. Maybe I am left with 2 more questions before we conclude, and these are the epic questions. I'll leave the spicy one towards the end, but I will start with, we cannot be spending 90 minutes talking about investment without mentioning ESG. And I think Steve alluded a little bit on to the ESG in terms of voting and the global agendas and so on. But for the household saving portfolios, for the corporate employee saving portfolios, is ESG choice fundamental on the economic returns and sustainability itself? Or, I mean, if we just put the ethical side away, and if we look at it just purely from economics, how fundamental, how valuable is the addition of ESG to the investment mix? I'd like to ask both Raphael and Altaf on this one.
I can start. First of all, I would say that taking into account ESG consideration in investing is removing or reducing a big source of risk. Some of the biggest corporate blow up in history have been related to basically poor governance, to make it simple. And therefore, it's not a big surprise that even if you have social consideration or even if you have environmental consideration, you have always to mix it with a decent governance, because at the end of the day, even if a company is doing or appear to do well on a social or environmental point of view, if the governance is poor, in fact, the trust in what the company is trying to achieve is poor as well. So governance is particularly important there. On the rest of particularly the E and the rest, let me comment on the environmental. For many corporate pension funds, we not only we integrate ESG consideration, and we have been doing that for, in fact, decades. But also more recently, environmental criteria. Why? It's very easy to understand. Particularly in Europe, where I am based, now you have the EU taxonomy, for example. You have MiFID II also coming, which means basically that you have big pressure on everybody, companies, first of all, but also investors. And also plan sponsor, so a retirement plan sponsor, to propose and to let's say transition their investment portfolio to a net zero emission framework. I think it's a good idea because progressively the world has to move there. Nobody knows whether it's going to be done in 10 years, 20 years, 30 years, 50 years, and so on. It's also very important consideration for the MENA regions, obviously, and therefore we are proposing net zero solutions for retirement products. I think it's a very interesting proposition. There are issues to deal with, but I think these issues can be dealt with financial expertise, and companies like us are able to provide that.
Thank you so much. Altaf, and keep it concise because we're approaching towards the end and we still have one more critical question.
Sure. Yeah, I think, Raphael made the main point, which is that for us, ESG is a question of risk reduction rather than excess return. But we do think, and I've done some research myself, that to show that it's about companies which are improving where you get the extra return. But we have to make the point that this is going to be something that is realized over the long term. So we won't be able to realize that in the next year or two. It's something, and we've been talking about long-term saving, that when people invest for decades, they will see the benefits of ESG initially from a risk reduction point of view, but we sincerely believe that it will also manifest itself in terms of excess return. Frankly, soon, the way the world is going, all investments will have some form of ESG in them, if not be completely ESG. So I'll keep it brief.
Excellent. So I'll ask these final questions and we have to close, and maybe you can answer me with your closing remarks. During this, a lot of economists comment say that the current inflation is not transitory. It's here to stay longer, and it's likely that it will rise further. And with it, there will be a rising cost of living that is affecting households' dispensable and saving capability. On the other side, we have the Russian-Ukrainian war is already on us. It's been here for the last 5-6 weeks, and there is strangely a global calm in the equity markets. That's maybe difficult to interpret. So against inflation that is still rising, it's not transitory according to certain economists. And also in the view of ongoing and continued Russian-Ukrainian war, what should households, what should I would say employee saving scheme managers and trustees and governors, what should they be doing, either themselves or their advisors, management advisors? What should be they watching and doing in the coming weeks and months?
So there's a way to cut through all this, which is, when do you need your money, right? And hopefully you don't need your investment money for a very long time. If you don't need it for a very long time, you do absolutely nothing different to what you're doing at the moment, which is that you try and make as much money as you can, you try and reduce your expenses without impacting happiness, and then you invest sensibly. And you carry on and you try to do that every month or every quarter. Doesn't matter what the stock market's doing, doesn't matter what's happening in Ukraine from this perspective. You just keep going. If you do that, you'll outperform nearly everybody over the long term. That no one has a crystal ball with this. You make an interesting point about the equity markets being relatively calm. I think they've been so kind of toughened up by COVID that people are just like, come on, what's next? We can handle this. And also bearing in mind that the Russian Ukrainian economies are not a massive part of the global market, but they do have some very big concentrations in nickel and fertilizers and things like that. So I think the market is in a kind of, they've got used to this war now, and they are in wait and see mode, because literally the war is so unpredictable that no one can do anything other than wait. I think inflation, there's nothing harder than predicting inflation and interest rates, as we've seen time and time again recently, and therefore certainly the individual person should not be keeping lots of money aside, but you need to keep enough money aside so that you don't need to dip into your stock portfolio when stocks go down and you suddenly lose your job or something like that. I think it's a much trickier job for pension managers that are taking on the risk of the investment. So if you are looking after firefighters and teachers and things like that, then yes, you have an incredibly complex job, and that's where you would turn to the likes of Amundi and SSGA to help you get through it.
And because Steve says I can turn to you, so I'm turning to Altaf and then turning to Raphael to shed light on this question.
Yeah, I said one thing, I mean, which we've all been saying from the beginning, is that you need to invest through these times of crises. And so absolutely what you should not be doing is selling your investments and putting your cash, under your pillow. You should definitely remain invested. And, history has showed us that equity markets have continued to outperform through wars, through other crises, and so on. So that's one thing that's absolutely clear, is that your investment behavior fundamentally should not change. But as Steve says, as you are getting closer and closer to retirement, your need to protect against inflation grows, and you cannot always be satisfied by a long-term investment in equities. And then you need to think about other diversifiers. So typically, we've been gliding clients into bonds, and bonds have played this great role. They've diversified, they've given you income, and they've given you growth as well. That's going to be less and less the case. And so we're looking at other ways of diversifying portfolios. But the same principles of diversification that Raphael talked about remain. It's just the instruments have changed. So we're looking more at real assets, at commodities, for example, at infrastructure. And as Steve and I have been saying, now in this day and age, there are many ways of easily investing in such assets, which would have been very difficult in the past for ordinary investors. You can buy ETFs which look at infrastructure. You can buy funds which invest in property and so on. So you need to think about diversification the same way you did before, but the assets have changed. And then finally, I think you need to really do think about inflation, about spending power, about what you need to protect, how you want to live, and so on. So it's about keeping on the same course, maintaining that discipline, continuing to think about diversification, but some of the instruments have changed. I'm thinking very hard about, how much you need and when you need to spend it.
Well done, well said, Altaf. Raphael?
I fully concur with what has been said. Let me just add a few points. First, why is it so difficult to understand what should be the equity market reaction on inflation? Is because you have two mechanisms at play. The first one is that when inflation is higher than growth, you have margin squeeze. So the company hit on their margins and therefore on their earnings, and therefore they should basically go down on the stock market. Put it simple. And the second effect that is even more difficult to forecast is whether central banks will be forced to tighten. What does it mean? Is that what the very important concept in valuation of any risky asset is real rates, basically interest rates less inflation, and is the reason why everybody is listening. What is telling the Fed particularly, and also the central banks in Europe, because if they tighten, it impacts a lot the potentially all the risky assets. Obviously, we don't have a crystal ball. We are expert. We have a bit of insight there, but it's very complex. Clearly, individuals cannot have this sort of insight, so they should remain diversified. That is very important. Second, what is very clear is that the losing asset class is in fact cash. In fact, typically, cash is the losing asset class relative to even bonds in this situation. And clearly, it's worse than money market with, let's say, a 1 year time horizon. So if we invest in a money market with 1 year, basically interest rates, so it's a bank account with 1 year interest rates, is a lot better than cash, than just having cash under your pillar. A lot better. You have a lot of history on this. And so the last point I would like to make, to go back to human capital, is that you need also to understand whether your human capital is going to keep pace with inflation or not. Again, if you are an MIT graduate, even in inflation, it looks okay because you will be paid even better. But if your human capital is relatively low, it's relatively unlikely that your income is going to keep pace with inflation, and therefore it's going to be another story.
Thank you so much, Raphael. Our dear guest, Raphael from Amundi, Altaf from SSGA, and Steve from Deadsimplesaving. I cannot thank you enough. I think you've been a think tank on investment, on advisory, on the discipline of long-term savings. For those thousands and hundreds of people who say we would like to start, we'd like to be serious, but we don't know how, I think you've given tons of insights on inflation, on the discipline itself, on the timing, the choice, the speak, the education. I think you've done a wonderful panel discussion today. I'd like to thank you so much again and look forward to discussing this further with you on other events and other platforms. Thank you so much. Bye-bye.
Thank you.
Thank you very much.
Pleasure. Pleasure to have you. Thank you.